Good assets can land in a forced sale. Axios and the Wall Street Journal report Citadel acquired Situational Awareness's stock book. This video follows the leverage clock behind that headline. Did the AI thesis break, or did its financing expire first? First, the two reports hide an important mismatch. Even the size of the handoff remains unsettled. Axios described the public equity exit as complete. The journal reported that most of the stock portfolio changed hands. Both accounts point towards Citadel. Their wording does not establish identical transaction boundaries. That distinction matters. A portfolio transfer records who held the stocks next. It does not, by itself, explain why the seller moved or what the buyer believes. The headline shows the exit door. It does not show the pressure behind it. To find that pressure, we need the public filing and its blank spaces. The most useful public document is also the easiest to misuse. Its omissions carry the real lesson. A Form 13F gives a quarter-end view of reported holdings. It is useful for locating visible positions. The filing is not a full balance sheet, and it does not reveal financing terms. So, the filing can make a concentrated idea look simple. Stock names sit in neat rows. The obligations supporting those positions remain outside the frame. Here is the contradiction. Other investors may still want the assets, yet the owner's financing can become impossible to carry. Asset demand and owner survival are different questions. Now the clock starts. One deadline can overpower a thesis meant to run for years. The journal reported pressure to produce cash as AI-related stocks sold off. The stated choices included selling holdings or securing fresh commitments. The reported purpose was meeting lender margin demands. Think of leverage as a hotel checkout. Your vacation plan can be excellent. The room still needs payment today. Falling collateral shortens the decision window until price discipline becomes a luxury. The market says, your decade-ahead thesis sounds fascinating. The lender points at today's clock. That timing mismatch, not a grand vote on AI, can decide the sale. This reading is conditional. It weakens if later records show little leverage, no forced sale pressure, or a transaction unlike the reported stockbook transfer. A stressed seller explains only half the deal. The buyer's advantage appears when speed matters more than perfect selection. Citadel lists $71 billion under management as of July 1, 2026. Scale does not prove its motive. It does show why the firm belongs in a different liquidity class from a pressured seller. A negotiated block can offer speed and one counterparty. It can also reduce the signaling created by repeated open market sales. The buyer gets a package, the seller gets a clock-stopping exit. That still does not certify every holding is cheap. A buyer can like the package price, the execution, or selected exposures. Transaction appeal is not universal stock approval. The cleanest countercase is firm-specific. This may reveal one portfolio's liquidity problem, not a broad message about AI infrastructure. That explanation fits the public evidence without stretching it. Return to the opening receipt. It tells us something important, but far less than the loudest interpretations claim. The event tells us concentrated AI portfolios can face brutal timing risk. It tells us financing terms may matter more than visible holdings during a sell-off. It also shows liquidity has buyers when terms become negotiable. It does not settle the future of NBIS, SNDK, or BE. It does not prove the AI buildout ended. And Citadel's reported purchase does not turn every related stock into a bargain. So, what broke? The available evidence points toward the financing clock, not the technology thesis. The next checkpoint is disclosure on leverage, sale pressure, and transaction scope. Different facts there would change the verdict. For another case where the headline hides the mechanism, watch The AI That Matched 10 Years of Research in 2 Days next.